And if you can hear me, let's talk about market sentiment. I mean, throughout the year, talking to market watchers, market analysts, they keep talking about the level of confidence at the market. Now, we know that the NSE has embarked or has introduced a number of initiatives to assure investors that the market is transparent and that there is fair play. And where companies err, obviously there have been punitive penalties meted out to these companies. But just to hear your thoughts on that side of the market, talking about market confidence, what are your thoughts?
Well, I think it's a double-barrel approach to the question. On the one hand is the fact that the waning sentiment we've seen from investors does not necessarily stem from a lack of confidence in the individual listed institutions, but much more having to do with the general economic trend. On the other side, of course, as watchers and regulators of the market, the stock exchange will continue to ensure that there is complete compliance with set rules. And so the essence in having penal cases where infractions are penalized is just to ensure indeed the integrity of the market, and of course in that manner guarantee the necessary confidence that should follow investors should they decide to make investments without the feeling of being led back. So on that basis, I do think that overall, in terms of regulation and in terms of the policy direction of the exchange, there's no loss of shine in terms of investors' confidence. However, the general economic outlook has had to have its own call on investment decisions. So investors will continue to juxtapose both issues. And I do think also that the relatively savvy investor has had no grind, to do with issues in terms of infractions. So by and large, I think confidence is high. And the only other reason why investors' participation may have shown some decline is largely because there are competing demands on the market and the provision of funds and liquidity.
Now, for investors who are watching the economy, obviously we're seeing the economy, the economic recovery still trying to gain momentum. But I mean, talking to your clients, talking to fellow traders at the market and investors, does anyone see a silver lining anywhere? Investors hopeful that at some point the economy will pick up?
Yeah, obviously, I mean, like the saying goes, when there's life, there is hope. I do not think we are anywhere near a loss of confidence to that extent. I actually do think that what investors have really done over the course of this year particularly is to switch portfolios. So what you've seen really is a question of a lot more funds flowing out of the equity space into other products that are available, whether on the money market space or some bond-related transactions. So it's a question of realignments. I do think also that the more the economy begins to assume a little more predictable pattern, which the equity space actually requires, we will see a return to some of these stocks over the long haul. Don't forget, the capital market remains a key indicator of the direction of the economy. And to the extent that the economy seems to suggest at some point some relative instability, you certainly continue to see such traction reflected in the pricing of stocks.
Now, you mentioned the fixed income market. I was just going to mention that also. Just before you came on, I was speaking to a fixed income trader, and he was telling me that, I mean, just looking at today's trading at the Treasury bills market, we're seeing yields already rates going below 8% already. And I was asking him, at what point would there be a pushback and how low, basically, can rates go? Well, while that is left to be seen, obviously depending on investors, so it's obvious now that there is still room for rates to trend lower at the fixed income market. What does this mean for the equities markets? Are we seeing that commensurate flow into the equities markets. Investors, obviously, choices, options are very limited at this point, and they have to put their money somewhere. Are you optimistic, and what does this mean for the equities market?
Yeah, I mean, there's always the theoretical standpoint, but there's also a practical appeal. Ordinarily, both markets should operate in an inverse relationship where we find interest rates, for example, if they are rising, then there's a direct impact, or there should be a direct impact of loss of traction for equities and vice versa. But quite often, the speed at which these things occur may not necessarily be so spontaneous. So over time, these positions tend to oscillate, and then of course find a middle course. So by and large, my take would be that for those who have been traditionally, used to investing in treasury bills and the like of other fixed income products, they will take a back step and see whether indeed the decline is going to continue. And should that continue, of course, by and large, they will tend to switch to equities. And if they do, of course, that will increase liquidity and the level of participation in equities. So, but we're yet to see that. And to that extent, we cannot at the moment say that that will remain the outplay.
Okay, I guess we'll keep our fingers crossed on that. Andrew, thank you for talking to us today. We appreciate your time. Andrew Tsaku, trader at Kapital Care Trust.